welcome back. Now let's go to the major terminologies that we have in the Forex market. Now we're going to be talking about all of these and then I'll try and explain them. We have the first one, which is trends. Trends. Trend is simply the direction of the market. We have two trends in the market. We have the bullish trend and then we have the bearish trend. The bullish trend is when the market is going up. Alright? And the bearish trend is when the market is coming down. When the market is going up, we call it the bullish trend. When the market is coming down, we call it the bearish trend. Now, what we do when the market is going up is we long or we buy. Alright? We long or we buy. When the market is bearish, we short the market or we sell the market. Bullish trend, long or buy the market. Bearish trend, short or sell the market. Alright. Now also remember that when we were explaining the basics when we were introducing the Forex, I told you that Forex, the currencies are traded in pairs. So for example, we have GBP and USD. We bring the two together, it gives us a currency pair, which for example can be GBP USD, right? And I also told you that there is a price assigned to it, which explains the difference in the valuation of the two. That is, how much dollars do you need to get GBP? And we gave an example that, for example, it can be 1.2345. So let's assume that the market at a particular moment A is 1.2345, and then it changes and goes up a little bit to 1.2346. Can you see the difference? 1.2345, 1.2346. That is a step movement in price. Now that step movement in price is what we call the PIP. The PIP is a unit change in price of the currency pair. The PIP is a unit change in the price of the currency pair. Now if the market is at 1.2345 and comes down to 1.2344, it is also a unit change in the price of the currency pair. We also call that a PIP. In other words, whether positive or negative, whether up or down, a PIP is a PIP. Now let's talk about lot. Lot is simply talking about the volume you're actually trading. In the market, you'll be able to determine what volume you want to trade, and your volume is a function of the account balance you have. When we get to risk management, we're going to talk a lot more about that, how that you need to determine your lot size before time. But just note that lot size is simply talking about the volume. So the more volume, the more account balance you have, the more money you have in your account, the higher the lot size you can trade. Okay. Now, also understand that as far as the Forex market is concerned, one lot is equivalent to 100,000 units. 100,000 units of the currency pair you are trading. So if you are trading GBP USD, one lot of when you want to trade one lot, it means that you want to trade 100 units of this particular pair. All right. So that is one lot. Now, remember I told you the other time that before 1971 it was difficult for people to trade because of the amount of money involved. But then Forex brokers came and they gave access to individuals like you and I to trade. What they actually did was to give us leverage. Now, leverage is more like borrowed money. They give you access to the market and they tell you to bring a certain amount. So you bring a certain amount and they provide the remaining. So for example, the leverage can be, if you have a leverage of 1:100. What 1:100 means is that for so it means that if you need to trade 100 units, you only need to bring one. Did you get that? So if you want to trade 100,000 units of a particular currency, and you are giving a lot of 1:100, what you just need is 1/100th of the amount you need to trade. So if you want to trade 100,000 units of GBP USD and you have a leverage of 1:100 because the brokers have provided you a leverage, instead of having to look for $100,000, all you need is just 1/100th of it, which will be 100,000 divided by 100, which gives you what? 1,000. So you only need $1,000 to trade this particular one lot. Did you get that? So that's how leverage works. Leverage is strictly money given to you by brokers to enable you enter into the market and trade as if you actually have the total amount of money. Now remember, I said in leverage there's a certain amount you need to bring, and I said 1:100. So for every 100 they drop, you need to bring one. That one that you are bringing is what we call the margin. That is your own deposit or your own contribution to the whole transaction. All right. So that is the margin. So when you don't have any money in the market, you will not be able to take advantage of the leverage. But when you provide your own margin, then you can come and then take advantage of the leverage that is being provided to you by the Forex broker. How that is clear. Now, remember I told you that the market moves, it can go up, which is a bullish trend. It can come down, which is a bearish trend. Okay. Now, there is one other trend that we talk about. It's not up, it's not down. It's just sideways. So sometimes the market can, sometimes the market can go up, sometimes the market is coming down. But in between this, you have a time when the market is not doing anything. It's called the sideways market, all right? Or the ranging market. The market is just going sideways, right? Now that brings us to indicators. Indicators are tools that help you to analyze the market. They will help you to determine if the market is going up or the market is going down. And then when the market is doing its sideways movement, indicators will also help you to pick that. So that's why indicators are very, very important. You really cannot trade without indicators one way or the other. All right. But the thing to note is when you're trading, you should not clutter your chart with indicators so that you're able to read what price is saying. All right. So we have stop loss and take profit. I'll explain that. Whenever you're trading, the beauty of Forex trading is you can predetermine how much you're willing to risk. So, for example, the market is, say, for example, I'm trading the market and I have GBP USD, okay, and the price is expected to be 1.2345. Let's assume that I use my indicators and I analyze the market and expected the market to go up. So I want to buy. But for some reason, my analysis, let's say, is wrong. And instead of the market going up, the market is coming down. That's a losing trade. But the advantage you have in Forex is you can predetermine how much you want to lose. So what you do is you pick a particular price that once the market gets to this particular price, I am willing to cut my losses and stay on the sideline. That's what stop loss will help you to do. They help you to predetermine your loss in any particular trade, and then you set it. So automatically, when the price gets to that value you've set, it will cut you off automatically. Also, we have to take profit. Now, assuming you actually bought this market and the market moved in your direction, you can also preset how much you want to make from the trade. You do that by fixing a take profit value. So when the market gets to that take profit value, it cuts you off and your profit is added to your account. I hope that is clear. Okay. Now, so we have currencies. I talked about currency pairs the other time. We have so many currency pairs. But then those currency pairs are classified into majors and minors. Major currency pairs are the most traded currency pairs in the world, and we have a number of them. What you want to do when you're trading is to maximize the majors. Why is that? Because the volatility is more predictable, the currencies are more stable, and they are more easy to analyze. So we have a number of pairs. An example of majors is the GBP USD I've been talking about. Okay. We also have Euro versus the dollar, which is also a major. Okay. We have USD CAD, that's United States dollar versus the Canadian dollar. So these are examples of majors that we have. We have USD JPY as one other major currency pair we have. All right, so these are examples of majors. And then we have minor currency pairs, or what we call minors. Minors are currency pairs that are not as heavily traded as the majors. So you can have a currency like US dollars versus South African rand, which is represented by ZAR. That is an example of a minor currency pair that are not heavily traded. They are not as important when we're talking about international trade as this one. Right, so these are the major terminologies you're going to be working with in the trading, your Forex trading experience. I hope you understand all the things that we've talked about, and then I'll see you in the next class. Thank you.